without further ado, I am going to turn it over to our first speaker for today, Victor Johnson, who is going to begin to talk to you about the importance and the rules of real estate investing. Victor, it's on you.
All right. Thank you so much, Darlisa. I appreciate it. This is a great brainchild that you pulled together, bringing us together with Marlon and yourself to help share information with the community about how they can leverage real estate to start building wealth. And these are such weird times that, we wanted to make sure we talked about real estate because it seems like there's two worlds happening right now. There's the world of people that are, obviously struggling and trying to figure it all out and get their finances together, maybe trying to get new jobs, maybe figuring out their employment, start a business or something. Then there's a world of people that really haven't been affected by the COVID situation financially. Their jobs were still good. They may have had to shift from in office to at home, but their income was stable. They already had savings, credit scores were decent. And we want to talk to those people because some of them are looking for real estate opportunities amid this time. There's the people that are struggling and trying to, keep balancing. And then there's those who will probably try to take advantage of great opportunities coming up in the real estate world. So that's what we're here to share today. Myself, real estate investing, I've been doing this for the last 5 years. And so let's dig into it. All right. All right, so what you're going to learn from this presentation today, and again, I'm one half of the speakers for today. I am a real estate investor, and so I'm going to speak more to the real estate investing side. Marlon will get a chance to jump in and talk. He's a commercial banker, so he'll be able to speak to you about the lending side for the real estate in the commercial space. So first of all, we're going to learn today the differences between residential real estate and commercial real estate. There is a big difference, especially if you are an investor. There's a completely different strategy and approach to investing if you're looking at residential versus commercial. Then there's also, we're going to go over some basic numbers for you to remember when you are analyzing these deals. It's important that you approach real estate investing just like you would do any other investment. It's all numbers. You got to remove a lot of the emotion out. It's got to be straight numbers and systems in place to ensure that you get the returns that you're looking for. I'll have some recommendations for types of properties that you can start out with for your first deal, whether it's going to be residential or commercial, and then benefits of both residential and commercial real estate investing. My sweet spot is the residential side, but we've started an LLC this year that we're going to be doing commercial investing. So I have a team that we've already put some things in place to start doing that. So I'll be able to share a lot of that insight. And then the types of funding for your real estate investment. And then at the end of my presentation, I'll be a special offer to throw out there for folks that are ready to take action now. Okay, so why am I even qualified to be here today? I am Victor Vanico Johnson. Many of you know me out there in social media world. I'm on LinkedIn, Facebook, Instagram. I like to share a lot of useful tips on credit, financial literacy, and of course, real estate investing. My background is I come from the collections world, so debt collection. So that's how I understand the credit reporting and the aspect of dealing with debt. I've written a book that tells how I even improved my personal finances, and my credit was in the low 500s until I was like 35 years old. I know I look like it now, but I'm in my mid 40s. So I actually was in my 30s before I figured out how to get out of the low 500 credit scores into the 700s and start building my real estate investing portfolio. So I outlined that in the book. We've started 555 Equity, which is our real estate investing arm for single families. And in my first 3 years, I was able to follow some very specific systems and rules. And we were able to acquire 7 rental properties in our first 3 years investing. So let's dig into it. For the respect of time, I'm putting everything on the screen here now for you. So on the residential side of real estate, it's very specific to being 1 to 4 unit properties. So we're talking about single family homes, maybe a home that you live in, a condo, townhouse. Those are all considered, residential properties. A duplex. So if there's a unit on one side and another unit on the other side, that will be considered a residential property. Even though you could be renting out one side and living in one side, they still consider that building a residential real estate transaction. triplex will be just like a duplex, except for there's 3 units. And then of course a quadruplex are those units where there might be 2 at the bottom, 2 at the top, and there's 4 total units. And that is what falls under the definition of a residential real estate property. On the commercial side, it's going to be everything that's pretty much 5 units or more. So there are such things as 5plexes, and also, of course, small apartment buildings. So this might be the sweet spot for people that are looking to get into the game, but also have enough equity and leverage to jump into a bigger deal besides a residential transaction. So those will be a smaller apartments, maybe a 8 unit, 12 unit, 20 unit is even considered kind of a small apartment building. And then of course, any retail space. I know a lot of people are looking at even storage spaces right now. That would be considered a commercial real estate transaction. So when you're calculating these deals, residential versus commercial, it is extremely, extremely important that you understand how you're approaching the transaction. And I want to make sure I got my timer on, so I'm again respectful of time. So what you want to make sure that you are looking at is this transaction falling as a residential? Is it a 1 to 4? Or is this a commercial property that falls into that 5+ realm? So first thing, again, with a residential is very specific. And I do want to qualify this. I am not a licensed real estate agent. I am a real estate investor. So I do understand the numbers, but I am not a licensed real estate agent. I happen to have a business partner who is one, and a office mate and a wife that is one. So my wife, Latasha Johnson, is a licensed real estate agent here in the Dallas-Fort Worth area. So if you're looking for a licensed realtor, feel free to reach out to me and I can get you connected with her. But so on the residential side, the investor or the buyer is going to always have the value based on the sales comparables. So what are sales comparables? And you may hear that term as sales comps or comps. Well, the sales comps are basically, they're going to take the property that you're looking at buying and they're going to compare it to a recently sold home in that same area that had the same exact location, size, condition, features. So if your property that you're looking at buying is a 3-bedroom, 2-bath, 2-car garage, 2,000 square foot property in this particular neighborhood, then the realtor or whomever you're dealing with on your team that has the expertise to pull the market analysis, or even a seller's team, they're going to be looking at how they price that property based on what other properties in the area that are 3-bedroom, 2-bathroom, 2-car garage, 2,000 square foot properties. So they're always going to base it on the comparable properties in that zone. I think some of them will go for a mile, maybe up to 3 to 5 miles, but it will definitely be the same size, shape, structure, condition of the property that they're looking at. On the commercial side, completely different strategy. And this is why commercial properties typically are better investments. Almost every time it's going to be a much better investment because it's going to maximize your dollars. But here's how value is determined on a commercial property. Value is based on the cap rate or the capitalization rate. And I'll explain that. So your capitalization rate takes into factor 2 things: your net operating income. The net operating income is basically how much of your total income you can derive from that property. So we always know that there's rent. So if you got, let's say we're talking about an 8-unit property and you got all 8 units rented out and each unit pays rent every single month, well, that is your income. But there are other ways that you could generate income on a commercial property. Perhaps you have a facility that has a laundry room where you are charging your tenants to wash their clothes. That is a revenue generating aspect that you could factor into your net operating income. You might also charge for specific reserved parking spaces or covered parking, depending on where you are in the country. So that might be an added cost that you could factor in. Any revenue generated from that asset will be factored in as your income. Now, as far as your expenses go, it's going to take into factor your total cost to run that particular asset. Debt service. Debt service is your note, how much you're paying to the bank or whoever financed that particular sale for you. So that is your note. That's your debt service. There will also be maintenance costs or rehab, whatever you're doing to fix up the property and get it cleaned up. You may have a staff, maybe an office manager or someone. You should be factoring your management costs. If you are managing it yourself, there's a fee for that. You shouldn't be managing properties free of charge. That should be factored in. So once you've got your total revenue from that asset and your total expenses for that asset, you come up with a net operating income. You take that number, and then you also need to know what the purchase price for that property was. Or some investors of commercial properties will prefer to go with the current market value. They should be similar, but they're not always the same. But when you're doing your capitalization rate, you will have to factor one of those, either the purchase price of the property or the current market. And so the equation is this: your capitalization rate equals the net operating income divided by the total cost of the property, or the value of the property, whichever formula you and your team decide to go with. So let me break it down a little bit easier for you. So here's an example of calculating your capitalization rate, your cap rate. So if you have a building that is purchased for $1 million, and so that's our sale price, and it produces $100,000 in positive net operating income. So we just said that net operating income is your amount left over after your fixed and variable costs are subtracted from your lease income or any other revenue coming in for that property during that 1 year. Then you would take that net operating income, 100,000, divide that into the purchase price, the $1 million, and that becomes 10%. So you have a capitalization rate in this example of 10%. So what does that really mean? So in layman's terms, that means that 1/10 of this building's cost, $100,000 of that $1 million, will be paid for in the first year's net proceeds. So that's a pretty good deal. You can have this big building that you're buying for $1 million in essence, based on this example, paid off, the first 10% of it paid off in 1 year. So what would it mean if you had a 20% cap rate? Well, that means it's going to take you 20 years to pay off using this formula. It would take you 20 years. Probably not the sweetest deal, right? And what if it's an 8% cap rate? Well, that means it's going to take you 8 years to pay off based on your net operating expense. So what investors of commercial properties have to determine is, am I generating enough revenue, net operating income from the property? Are my rents high enough? Are my expenses too high? What do I need to do to get this number bigger? And more importantly, on the upfront, am I paying the right price for that building? So you have to factor these things in to make sure that your investment is a smart investment. All right. So hopefully that made sense on the commercial side. Obviously, reach out to me. Here's my website, and I'll have my contact information on the last slide as well. On the single family side, or the residential side, what I've used is a very, very basic formula. If I cannot generate $200 a month in cash flow, because again, we're dealing with comps now, so I got to look at what the market in that area is going to draw for that property to get rent. So is the average rent cost $1,200 for this house, this 3-bedroom, 2-bath, 1-car garage, 2-car garage? Okay, well then my principal, my interest, my taxes, and my insurance, which is my note, it might be a total of $800 that I'm paying for that property, but I'm collecting $1,200. So I've got $400 still there. But remember, on a couple slides ago, I said, make sure that you factored in your management cost. So if you're managing the property yourself, or you're paying another entity to collect rent, to deal with maintenance tickets, then that should be factored in as well. So let's say that's $200 a month. So with the $800 for my principal, my interest, my taxes, and my insurance, plus the $200 for management costs, my all-in expense to run this single family residential property is $1,000. Well, if I'm collecting $1,200 in rent, then in this example, $200 a month, is my $200 a month is my actual profit from that particular door, that individual door. So when I'm factoring whether or not this is a smart investment or not, I'm looking at the cash on cash return. And I never want it to be below 10%. Ideally, I'm looking at 12%. How do I get to that number? Well, my cash flow is $200 a month based on what we just talked about here, times 12 months in a year. So for the year, I would have a profit or cash flow of $2,400. Well, I divide that by the total cash that I took out of my pocket to buy that property. And let's just say I had to come up with $24,000. I did that to make the math easy. So $2,400 cash flow for the year into my $24,000 is a 10% number. Well, again, I really wanted to be in that 12% number. So I need to find a way to generate closer to $3,000 in cash flow for the year so that my numbers are closer to 12.5%, 13% of cash on cash return. And again, if this is going too fast, I only got 20 minutes. Now I'm down about 5. And I just want you to get a general idea of calculating your deals between a residential deal and a commercial deal. And then the biggest one is the equity. I need to be able to buy this property for cheaper than those sales comps are saying that that property is worth. If the sales comps say that the best looking house in the neighborhood that looks like mine or the one I'm looking to buy is $100,000, I need to be able to buy this house for $75,000 because I know that there's some work that needs to be done on it, but I still need to be able to buy it at a purchase price that's about 25% less than what the best valued house is in that area. Because I got to have some room to make that profit. I'm an investor. I'm not looking to buy that house to move into it as my forever home. I'm looking to turn that into a cash flowing, income producing property. So again, I'm running short on time here, but I want to give you some benefits to both residential versus commercial. Cash flow. I just showed you that. If you get enough of these bad boys, you can replace your current income with what you're making in your cash flow from your rental properties. You know, definitely it's helped me. I'm a full-time entrepreneur. Principal pay down. So you have a tenant that's renting out this house and they're paying that principal, interest, tax, and insurance that I just told you about. So they're paying for the expense of you to own that house. And you look back 2, 3, 4, 5 years down the line and they've knocked out 20 to 30% of the principal balance on your note. That is a fabulous benefit. Equity, I just told you, being able to buy that house at a lower cost and increasing the value by putting some work into it, you force the value up. Appreciation. Real estate is one of the very few things that you can invest in our nation, in our world, that continues to show cash on cash returns, a higher appreciation rate. Using this example nationally, and these numbers are a little dated. This was earlier this year that I pulled these numbers. But if you bought a house for $100,000 in July of 2019, nationally, the average is about 5% appreciation. So a year later, without doing very much work to it, just making sure you keep it, you push the value up 5%. Just nationally, that's the average. Obviously, in different markets, it'll be less, but in some markets, it'll be greater. I may have some viewers here from Atlanta, and in your market, you're seeing really closer to 7% return annually. I live in Dallas. Dallas is smoking hot for real estate. You got to have more equity to bring to the table, more money to bring to the table. But if you can get in those deals and follow a system that's been laid out that is number driven, and you can get the return on your investment at 10% of appreciation. And then, of course, there's always going to be tax benefits, whether you're doing residential or commercial. I'm not a CPA. Consult your tax professional for various codes that are available for real estate investors. On the commercial side, substantial current income and spendable cash. Again, same formula as the residential. You got this person paying rent, but you have multiple doors, and each door is cash flowing you pretty substantially based on what your net operating expenses are, your cap rate is. Excellent appreciation. You know, when you buy real estate, it's just going to continue to appreciate unless you're in the wrong market. Certain areas, especially now with COVID, you do need to be mindful of the markets. Are the jobs gone away from that market now? Are people moving? Are people not able to continue to work and live and pay rent? Those are all factors that you have to think about as an investor. Accumulate significant equity through leverage. So leverage is being able to use other people's money to invest. So we're going to talk to Mr. Marlon here in a second and find out how his entity can leverage your deal and help you to get into that transaction without you coming up with 100% of the cash needed. Multiply that current cash flow through leverage. So again, using leverage, using other people's money, you come up with less out of pocket, but you're still benefiting from the multitude of that asset. And then of course the tax benefits. There's dozens of tax codes to benefit real estate owners and real estate professionals. Okay, so wrapping up, again, on the residential side, I would look at something that's under 1,500 square feet. The smaller the property, the smaller the expense to rehab that property. So those are things you want to think about. You know, I shy away from townhouses and condos because there's usually a homeowners association that eats into my cash flow. I don't like nothing that eats into my cash flow. So that is something you would have to factor into your numbers if you decided to go with that. But you might be able to get a bigger rent payment because typically in certain markets, you might be able to attract young executives that are making higher earnings. Duplexes, I love for beginners because you can live on one side. You can actually probably finance that transaction as your first home and maybe get in under FHA at 3.5% down payment, but you still have it as an investment property because you're renting out the other side. Commercial properties, 5-plexes and 5 to 20 units are sweet because typically these are owned by, you know, mom and pops like myself and my wife. You know, we may be owning this. It's easier to negotiate with me than negotiating with a big entity that has to go through legal compliance and all these other factors. You can usually work out deals better. And a lot of times they're more willing to work out financing with you if you can't secure the traditional lending. Commercial small spaces are good now, especially a lot of entrepreneurs out there like using co-working spaces. If you could find a building that you can have social distancing responsibly and also have it to where people are in a space where they can come in and meet with their clients. That might be a great investment from a commercial side. Storage spaces are great as well. Lastly, ways to fund your real estate investment. Obviously, the number one way is conventional lending, having good credit, having the equity available to put as your down payment. Obviously, Marlon will talk into the specifics of that here in a second. There are also lender brokers out there that are independent. They just are tied to various lenders out there and they can help you with your specific situation, match you with the right lender. Creative financing, just told you if there's a mom and pop out there that is willing to work with you on the financing, a lot of times you can do that with those smaller commercial properties. And then cash, you got cash is king. You can pretty much do things with that, but you don't have the leverage. You're not using other people's money, so the returns may not be as sweet. So my challenge to you is take action, do something. Don't sit on your money. Sitting money in the bank right now is losing you money with the appreciation, or excuse me, the rate of, the cost of sitting money in there and leverage and all this stuff is just not, it's just not smart to just have it sitting there. It's only a 1, maybe 3% at best return on money just sitting there. I love real estate. I'm not a stockbroker. I have some IRA and some stocks, but real estate has proven to be a time-proven way to make money. Cash on cash returns consistently and compounding interest. So if you're looking to accelerate your journey, you want to try to find somebody who's done it, that has a system in place. We've got some offers out there. Everything right now, because we relaunched our brand, everything is at least 40% off. So if you're looking to get into real estate investing, we offer online courses, videos with support that we can help you get through that initial journey. We already know all of the mistakes you're typically going to make because we did them. So we can help you get through those. And if credit is an issue for you, we also offer those programs. And then just in general, if you just want to learn more about my journey and how I was able to get out of debt, attract more finances, and build a real estate portfolio, download a free copy of my book. Doesn't cost you anything. And we love for people to connect with us on YouTube. So that's it for me. I went over by a couple minutes, but we still had a good time. It's 12:26 Central Standard Time. I want to hand the ball over to the money man. If you are looking to get your financing going, it is very important that you understand the criteria that it takes for you to borrow other people's money.